Hi, good morning. This is Trish. Thank you for joining us on Realty Check this morning. Hey, if you guys are watching the show, please take a minute to give us a review, share it with your friends, download us if you're listening to us on iTunes. Make sure you subscribe so that you'll get notified every week when we have a new show come out. Thanks again for joining us, and we have a guest with us today. Raymond Al Wagner. I know him as Al, so I'm going to be referring to him as Al throughout this show. Yes. Al is EA with Trinity Tax Consultants. Al is the person that keeps me out of trouble every year.
I do.
Yes. Al's going to talk to us about some interesting things that we need to know about taxes, about how taxes can affect real estate, what things that you guys need to keep in mind when you are purchasing or selling real estate, and all of that fun stuff, because it is that time of the year again for you to start thinking about getting your taxes prepared, getting your taxes filed, and doing all that stuff that's coming up sooner than we imagine. Al, tell us a little bit about yourself.
Well, listen, I'm an enrolled agent, and the tax practice, I've been doing this 37 years. And our primary focus is on tax preparation, tax planning. Then, of course, if people have problems, we fix that as well.
Right. So, Al, you have a very big, strong background with working with the IRS.
I do. Well, 37 years.
Yeah. 37 years.
When I call the IRS, I know what they're going to say before they say it.
Yes, and that's good. As a person coming to you from the very first time, and I've been going to you for years.
Right.
I knew nothing about what to do. Of course, we're all confused. We don't know tax law. That's very confusing altogether. And you're very knowledgeable. You've you helped walk me through things, feel comfortable, let me know what to do without breaking the rules. A lot of times I hear people like, oh, I have this great CPA and they do all these cutting corners, and I'm like, no, don't do that, because I don't want to be in trouble.
And then when they get in trouble, they call me. Hey, I have a problem here.
I have a problem. This great CPA cut all these corners or did all this stuff, and it didn't work out.
Exactly.
So you're very good at guiding us through guiding through the right thing to do.
What I try to do too is I try to translate this into everyday English, where it makes sense.
Absolutely.
Because if you read the tax law and the instructions, it's confusing. So when I meet with people, I try to say, okay, this is how it works, and lay it out to where it makes sense, where you understand it. So
right.
That's important.
And that is important. And I appreciate that, because I do not understand it.
Join the crowd.
So just to put this in perspective, the things that we're going to be talking about right now in regards to taxes, just as like a disclaimer out there for everybody, is we're in the year 2020 right now. So things can change. If you're looking at the show in 5 years, we cannot guarantee that things will be the same as they are today, right?
Goodbye 2020.
Goodbye 2020, please.
Thank God.
Please get us out of this year.
Exactly.
But yes. Yeah. So
this is, okay, yeah, it's the end of the year now, and we're short on time. So if there's things you need to do, it has to be done before December 31st.
Okay.
Such as set up a 401k or whatever for your company.
Right.
But now's the time to start planning. What do I need to do to get all my stuff together? What do I need for the tax return itself?
Okay.
So, yeah.
And then as we get into discussion on the different topics we're going to talk about today, people may be wondering, who do you help? I mean, obviously, I'm a business owner. I'm a realtor. I know you can help me, and you're very good at helping business owners, realtors, or myself, and I've sent a lot of other realtors to you. But can you help the average? Average.
Yeah, I can help anybody, and anybody needs help, I can help them.
Okay.
But we do focus a lot on sole proprietors,
Okay.
small corporations,
Okay.
and again, that goes into the planning.
All right.
Should I do this or should I do that, and how's it going to affect the taxes?
Yes.
So we try to, help people go into their decision-making process, eyes wide open. How is this going to affect me, not only from a net worth point of view, but how's it going to affect me on the tax side?
Right.
So that way there's minimizes costly mistakes.
Right, and planning is huge. When I first met you,
Like what?
I was making a lot of bad choices. So
So you're
Planning is
normal.
huge.
So
Yeah.
you're normal, right? That happens.
Planning is huge. So yes, you do learn, and you did help me learn to operate like a business. So
Exactly.
that was very important. Now, for a lot of our guests that watch the show, we have realtors, we have homeowners, we have home sellers that are tuning in. We have investors now that are tuning into the show. So I have a pretty diverse audience out
Right.
there.
Okay.
So let's talk first about homeowners or people that are thinking about buying a home.
Okay.
What kind of, there's so many benefits to buying a home. Buying a home is definitely a great decision no matter how you slice it,
Yeah.
but there's also tax benefits to buying a home.
Correct. So the mortgage interest, so when you buy a house, you have a mortgage. So the mortgage interest is deductible,
Okay,
and then the property tax is deductible.
okay,
So if you itemize. Due to the Tax Cuts and Jobs Act of 2017, the standard deduction doubled. So a lot of people that were itemizing, they're taking their mortgage interest and their property tax as a deduction, aren't able to do that now because it doesn't go over the standard deduction.
okay,
Okay? So before, it was a better benefit to buy a house than it is now, but leveraged property always gives you the greatest rate of return.
okay,
Okay? So even if you're not able to take advantage of writing off the mortgage interest and property tax, the fact that the home is going up in value, right? Compared to how much you put down on your down payment, your rate of return is much greater.
Well, yeah,
So
equity.
Exactly. So for the best example, and I'm going to just use round numbers, let's say you put $10,000 down on a house, a $100,000 house.
Okay,
So you borrow $90,000, right? And let's say the value of the homes are averaging 3% increase in value a year.
okay,
So at the end of a 12-month period, the house is now worth 103,
okay,
right?
right,
Well, you only put in 10,000.
yes,
So your 10,000 earned 3,000,
absolutely,
which is a 30% rate of return.
yes. It's more than you get on a
You're not going to
savings
get that at
account.
the bank.
Yeah, no,
Just saying. So if you think of it in that terms, yeah, you definitely have to buy a house.
Yeah.
Not to mention the stability and all that other stuff that goes with it.
yes.
Yeah.
Well, actually, I use that same formula a lot in investments when you're looking into an investment property.
Precisely.
Because investment properties, you have to put a large down payment, usually 25% down minimum. And that too, you're investing that money, which seems like a lot of money, but if you have the cash there, what are you making in the bank?
That's exactly right. Even in the stock market, you're just not going to get that kind of return.
Yeah.
And it's long term, obviously. Because over if you really think about it, the older generations, they would get 2 or 3 rental properties, hold them for 20 or 30 years, and then that rent was their retirement income.
Yeah, yeah. The rent is what they actually
Or they would
live
sell
off
it
of.
and hold the note.
Yeah.
And so that mortgage payment that went to them was their retirement.
Yeah.
So there's different ways to look at it. Again, you have to go in eyes wide open. So.
Yeah, most definitely. And there's a lot of things to consider. That's having a good realtor and hiring a good realtor to advise you on those things is always a good idea.
Exactly
I do
right.
take phone calls.
Best, you have to get the best price, of course.
Yeah, of course. So there's a lot of things to go into that. So, as far as like the tax things, I know that previously, before the Tax Act, the previous Tax Act, I don't remember the year you just said, but
2017.
2017.
Right.
Before that, doing itemized deductions was usually not even possible unless you were a homeowner.
That's correct.
Does that still apply?
It does. So, for example, okay, you're married filing joint.
Okay.
So your standard deduction is $24,800, I believe, this year. So your mortgage interest, the property tax, your donations to charity, your registration tax on your car, all that would have to go over the $24,800. If it doesn't, then you take the standard deduction.
Of course.
Under the 2017 law, under the old law, it was $12,000.
Okay.
Okay, so let's say you buy a house and you have $14,000 in mortgage interest.
Right.
Under the old law, then yeah, that qualifies you to itemize. Under the new law, well, it's not it's not near that 24.
Yeah, so you're going to take the higher amount
You're gonna take the
instead
higher
of
amount off.
itemizing.
Exactly.
But that's if all of your deductions don't equal up to that amount, because you also think, a lot of people donate to charity.
A lot of charity
and you have all the other deductions that you have that
Exactly.
you'll take off on top of that as well.
Exactly, right.
Yeah. So there's always I know every year before filing taxes, I always print out what deductions are there available. To
Exactly.
make sure that you're claiming everything that you can. You don't want to leave money on the table.
No, you don't. Take advantage of every little rule there is.
Yes.
So,
Yes, absolutely. So what about things to track? Like right before we go to file taxes, you're regular, say you're a regular homeowner, you have the deductions, you do want to itemize. What are some of those things that, deductions, things that you need to keep track of, receipts you need to keep?
well, you definitely want to keep the receipts, especially for donations to charity.
Okay.
You want to keep the receipts or the canceled checks, Some of the things that are overlooked is the miles that you drive for charitable purposes.
Oh,
So let's say you volunteer at church or with Three Square or Project 150 or one of those. The miles you drive doing that charitable work is deductible,
oh, that's interesting.
and most people don't
No,
think about that.
right,
You know,
right.
it's not a lot of money, but it's take every dime you can get.
Absolutely, it's still a deduction. And when you go into charity, and keeping the receipts, I know the answer to this. I'm just going to act like I don't for the audience.
Okay.
So, when you go into that and keeping the receipts, so like if you donate cash and you don't have a receipt for that, you can't deduct it.
Well, you can, but you have to have some sort of a notation as that I took that money out from the ATM or
You have to have a paper trail.
some kind of
Yeah,
paper
you
trail,
can't you can't just say that you donated $10,000 to charity and have nothing to show for it. It
They say,
doesn't work that way.
Where'd the 10,000 come from? Well, it was cash. And,
Yeah,
it came from
just
somewhere.
fell out of the sky, and I gave it to charity because I'm
Exactly.
nice. Yeah.
So, and the thing is, that's important to keep all the receipts. If you donate more than $250 to one charity, you definitely need a receipt.
Okay.
If it's less than $250, you don't necessarily need a receipt, just maybe a canceled check or something along those lines.
Okay. What about like charity goods? A lot of people do the donations to Goodwill or drop-offs at Safe Nest or something like that.
Now, typically, the first $500, you really don't need a lot of evidence. Okay. Anything above that, you have to itemize. I believe it's on the IRS website. That gives you a general valuation of, let's say, a bag of clothes and bedroom set, what it would be worth.
Oh, okay.
So you can just, as long as you get it close.
Yeah. Reasonable.
But you have to, if it's more than $500, you have to itemize who you gave it to, what was it, and if it was more than $5,000, then you need some sort of an appraisal.
Right.
Let's say a car or maybe
Oh yeah.
something
Because
like that.
people are doing that now. The vehicles and everything as
Exactly,
well.
yeah. But that all adds up with your mortgage interest,
Yes.
the property tax, the tax on your vehicle, your registration, right? And so again, you're trying to get to that magic 24,800 number if you're married,
Yeah.
12,400 if you're single,
Right.
to go ahead and itemize.
Yeah. Okay. All right. So yeah, definitely there's things there that you do not want to leave on the table, because if you're, and that's what, if you're a W-2 employee and you have taxes taken out of your check and you are able to itemize and have more deductions than what you paid in, that's how you get a tax return, correct?
Exactly.
Yeah.
So,
And then, some others, we have to pay taxes.
that happens.
That's fun, but it happens.
Yeah.
But that's how those things,
Exactly.
those numbers are worked
Right.
out.
Now that's on the primary residence side of things.
That's the primary residence. Now let's talk about investments.
Okay. So like rental properties.
Yes.
Okay.
If you own a rental property, are there tax benefits to that, or are there tax repercussions?
There's huge tax benefits to rental properties.
Okay.
Okay. Number one, you don't have to beat that $24,000 threshold, whether or not you take the deduction.
Okay.
So on rental properties, you claim whatever rent income you collected, then you take off your mortgage interest, the property insurance, the property tax,
Okay.
and then any repairs, any utilities, and all that.
Yeah.
Plus, you get to recover what you purchased the property for, the building.
Okay.
So you reclaim that through depreciation.
Okay.
So again, let's go back to the $100,000 number, which is probably kind of low, but let's say $100,000.
I'd love to find a rental property for $100,000. Do you know
right?
where those are at?
It's a cracker box.
Yeah.
Anyway, on every $100,000, the depreciation roughly is around $4,500.
Okay.
Okay. So if it was a $200,000 house, you're looking at around $9,000 in depreciation.
And that's every year?
Every year for 27 and a half years.
Oh my goodness.
Actually, they just changed it, 30 years. So now it's a 30-year window.
Right.
Okay. You can't depreciate the land, but you do the building.
Okay.
Okay.
Mm-hmm.
So what will happen is, let's say you get a rental property and you rent it out for just exactly what the mortgage is.
Mm-hmm.
By the time you get the depreciation deduction and the insurance and all that, you may end up showing a negative on the tax return. So it lowers your taxable income. Okay?
Right.
But the property still goes up in value.
Yeah.
Okay, that's a win-win.
Right. Absolutely. So
Yeah.
the property is raising in value. You're making income, but your taxable income is getting reduced because of the depreciation.
Yeah, so the rent covers the mortgage
Uh-huh.
and your expenses. So even if you break even, the depreciation creates the loss.
Okay.
So,
And if you're not breaking even, if you have a mortgage payment and you're making money on top of that, it's just taxable
It's
income?
taxes, ordinary income, that's correct.
Ordinary income. Okay. And that's whatever tax bracket you would regularly be in, or is it usually at a higher rate?
No, it's at the same rate as all the rest of your income.
All the rest of your income.
So it's bracketed up at, I'm trying to remember this off the top of my head. It starts at 10%, 10, 12, 14, and I think it jumps up to 22. Anyway, so the more you make, then the higher tax you pay.
Right.
But the first money you make for the year is taxed at a lower rate.
Okay.
So it's bracketed up.
Okay.
Yeah.
All right.
Yeah.
Yeah. Those tax brackets. That's a formula I don't think I'll ever understand.
It's difficult to explain too.
I can only imagine. It's like, who makes these numbers? They make it difficult to understand, but
do.
that's good for you because that's why you're here.
What's even more complicated is the capital gains. So
Okay.
if you sell something for a profit, then depending on how long you hold it, the tax rate may be different than your ordinary income. It may be at a capital gains rate.
So I didn't know that. You just taught me something. Yeah. So in real estate, as a realtor, people will always say, like, when they're selling an investment property, what's my capital gains? Or, when they're selling a property, what am I going to have to pay in capital gains? I can't offer tax advice. I don't get to tell them the answer to that, and I don't know it because I'm like, well, I've heard some people say it was somewhere around here, and other people say this, and I don't know what makes the difference.
Okay. So in its basic form, the short-term capital gains is taxed at whatever rate your income rate is. Okay, so it's not just ordinary income.
And now short-term capital gains is what?
Property that you held for less than a year and sold it.
So that's like if you were to flip it, maybe.
If you flipped a house, it's a short-term gain.
Okay.
Okay. Let's say you flipped a house and it took you a year and a day, so you held it for a year and a day. Now the profit is subject to the long-term capital gains rate,
Okay.
which is lower than your ordinary rate.
Oh, okay.
Okay.
So owning it longer than 1 year actually has a benefit.
It's a benefit, exactly.
Oh, I did not know that. That's great.
So when you're meeting with your people,
Yeah.
buy and hold is the way to go,
Yeah.
because you get a lower tax rate later on the profits.
So does it get lower as the years go by, or is it just one?
It's just when
Jump.
you pass that 1 year and 1 day mark.
Okay.
Okay, and so the capital gains rate, again, off the top of my head, I think they just changed it. It's 10, 15, and 20 right now. So let's say you're in a 15% tax bracket.
Okay.
Your long-term capital gains is going to be 10%,
Oh.
even though you're paying 15%.
And that's if you owned it longer than 1
Longer
year.
than 1 year.
Oh,
And
okay.
if you're in a 20% bracket, the most you pay is 15% on your long-term capital gains.
Okay, now that does not sound horrible. For some reason, I've
No.
heard that they're like 40% sometimes, and
Everybody thinks long-term capital gains is a bad thing. No, it's a good thing.
okay,
I don't know why.
I
It just
didn't-
got such a bad rap.
I know, right? And I didn't realize that difterence. And there's There's one more question I wanted to ask you. I want to get into opportunity zones, if you don't mind.
Okay.
But before I ask that, I want to get into primary residence when you sell, because we're talking about capital gains right now.
Right.
When you sell a primary residence, do you have to pay those capital gains taxes?
Okay, there's an exemption on your primary residence.
Okay.
So you're married.
Yes.
So let's say you sell your home and you have $400,000 in profit,
Yes.
okay?
Yeah, that's great.
The first $500,000 you make in profit on your primary residence is tax exempt. If you live there for 24 months out of the previous 5 years.
2 out of 5 years.
2 out of 5, 24 months.
Yeah. Oh,
Out of 60 months.
24 months.
Anyway.
Yes.
But it'd be $500,000 tax free.
Okay. Where do I sign?
Just sign me up. And the other thing too is, like, people say, well, I don't really have to file this year because I just sold my house. Even though you sold your house and it may not be taxable, you have to report it
Okay.
and let them know it's not taxable.
Yes.
So if you didn't put the sale of your primary residence on your tax return, the IRS sees a sale of $700,000.
And they don't know what it's for.
Well, that $700,000 is taxable, and then they're going to send you a bill.
Yeah.
But if you put it on your tax return and explain, no, we don't want to pay tax on the 500 or 400 or whatever the number is, then you're good.
Yeah.
Right?
Okay.
If you're single, it's half of that. So you're able to take
250.
$250,000 tax-free on your primary residence.
Okay. Now, another interesting thing is, this is where I tell people to check with a resource.
Right.
Call a tax advisor and ask if this is a good decision, because I know that it's not a great decision for people. Some people will sell their house, and it will be their primary residence. They'll decide to sell and move into another house, but they want to keep it for just a couple years as a rental and then sell to build more equity. However, if they're not keeping it for a long period of time, but they're keeping it long enough to where they're not going to have that exemption, that probably isn't a great idea.
Now that's tricky. If you take your primary residence and convert it to a rental,
Yes.
right? And let's say you lived there for 5 years, just pick a number, and so you convert it to a rental, I wouldn't rent it any more than 36 months before you sell,
Right.
because you still have to do the 24 months out of the previous 5.
Yeah.
Okay, previous. So if they rent it for longer, then they're going to lose that.
Yeah. If you're going to do a long-term rental, like you're planning on keeping it 30 years as a rental, go ahead, by all means. You're not going to be selling it anytime soon. But for the people that are like, I just want to rent it out for a few years.
If they rent it out for a year or two, that's fine.
Yeah.
You just want to make sure that you don't go past that 36 months, because you have to live there for 24 out of the previous 5.
Yeah, and then you're gonna get a tax bill on it when you sell it.
And sometimes, maybe they're not in a position to sell it because maybe there's no equity.
Yeah.
Okay, so if there's no equity, well, fine, just.
Yeah, there's no equity. There's no equity. But if you're sitting on it to build equity, but then you're going to take that equity, the extra equity you built, and then pay it in a tax bill, doesn't really make much sense.
No, it doesn't.
It doesn't. No. You got it, and that's why I say, talk to a CPA and just ask them if that's the right decision, because I can't give tax advice. I'm not licensed to.
And you want to run the different scenarios.
Yeah.
Okay, if I do this, this happens. If I do that, that happens, and run the actual numbers.
Yeah.
And you can figure out, okay, well, what's the best way to go?
Yeah. And this is the reason why people at home, you do not want to file taxes yourself, because there's so many mistakes and things that those little apps don't show you. I highly, highly, highly recommend hiring a professional, because I just don't. I think that people get themselves in more trouble with that than they.
They do. If it's just a W-2 or maybe basic return, they can do it themselves.
Yeah.
Anytime there's self-employment or maybe rentals, then it's real easy to mess up.
Yeah.
And then they have to call me to fix it.
Yeah. And if you're dealing with income properties, itemized deductions, things like that, you really should be talking with a professional that can guide you through what to do. Yeah. So you taught me about the opportunity zones.
Oh, right.
Yes, so that is, can you just like a brief summary of what that is and why that's important to know about?
An opportunity zone, again, was passed by the 2017 Tax Cuts and Jobs Act.
Okay.
Which you can't really say that very fast. But anyway, each governor of each state had to identify zones where more than 50% of the population was below the poverty level. So they said, okay, this is going to be an opportunity zone. So there's a tax incentive where if you invest in an opportunity zone and revitalize the community, you remodel the real estate, or you build a shopping mall and bring grocery stores in and create jobs and kind of rebuild the community.
Right.
If you hold that investment for 10 years and then you sell, 100% of that gain is tax-free.
You mean like tax-free, like no tax?
No tax. No tax.
100% of that gain.
Zero tax.
Oh my goodness.
So you can
10
make,
years.
yeah, right, exactly. Now, if you sell it before the 10-year window, then there's going to be tax, but it's going to be prorated depending on how long you held it
Yeah.
over that 10 years. Matter of fact, we're sitting in an opportunity zone.
Oh, okay.
We are.
Okay.
Okay.
All right.
And so if you notice, like in this area right here, especially right down the street, all these beautiful new high-rise condos.
Right.
I'm like, why would they put that there?
Yeah.
Oh, I know. Tax-free.
Right. So there's another area like over in East Las Vegas that all of a sudden, it just for years, there's never been great stores or shopping or places to shop or restaurants over in that area. And now all of a sudden, all these big chain businesses are popping up everywhere. And I'm like, wow, it's great. There's places to go now. But that's exactly
wrong.
the reason why.
The Meadows Mall is an opportunity zone.
Oh, why is it empty?
Don't know.
I mean, it's not completely empty. But it's a lot.
It's in an opportunity
lot
zone,
emptier than
which
it used to be.
surprised me.
Yeah.
But that's what the tax bill that they signed was designed to have a public-private partnership to rebuild the inner cities.
Okay.
That's why it's there.
Yeah.
Okay.
Uh-huh.
So you might as well have private companies go in there and do it with an incentive from the government, a little motivator like tax-free money,
Yeah.
right?
Yeah.
It seems to be the most effective way to do it. So.
Absolutely, and I mean, yeah, it's why not invest in something that you can get a better return on.
And there's, it's on the market. You can buy into companies that are opportunity zone companies, like on the stock market, where they do the investing and all this other stuff, and you just own shares,
Oh, really?
like General Electric or whatever.
Okay.
Okay, I don't know the names of them, but that's an easy way to invest in the opportunity zones without having to go out and just do it yourself too.
Oh, okay. All
Especially if
right.
you don't have a lot of money to do it,
Yeah.
I really can't afford a shopping center right now, so, something like that.
Yeah, most definitely. And I've heard that there's in some of the spots where they're doing it, they're trying to do like businesses that can be reached by foot traffic to just like have a kind of a like the arts district area.
Exactly.
Have that like a kind of outdoor
Right.
area that can be.
And it makes sense.
Mm-hmm.
I mean, really, if you said the Meadows Mall is almost empty.
Mm-hmm.
Well, yeah, that should be an opportunity zone, because go in there and rebuild that and bring it back to life.
Bring it back to life. I know. Where's all the malls? I know people are, especially now. I mean, and these
Oh, yeah,
days,
well, that's true.
whatever. That's a whole nother subject. But all of these, just the places to go and shopping centers. I know a lot of people are doing online shopping and everything now, and maybe I'm just like old school thinking, but I miss the malls. I miss the like being able to hang out in like an area where you just go shopping or do whatever you
And
need
I think,
to do.
once we get through this whole COVID thing, it'll come back to normal, a new normal.
Yeah. Well, the malls are going away before COVID, though. The stores were, they were just getting empty. They're just not. I don't know. The teenagers, the kids now don't hang out there like they did when we were younger. So.
They're playing video games.
Yeah, they're playing video games. Maybe they need to have like video game sections throughout the malls
There you
to
go.
make them go.
Yeah, exactly.
Yeah.
And then we're back to rentals.
Yes.
What happens if you sell them?
Yes. What happens when you sell a rental?
You pay the tax.
Because you
No,
depreciate the rentals over all the years. How does that work?
This is where it gets complicated.
Okay.
So let's go back to the $100,000 number, okay? So let's say you paid $100,000. Well, you depreciated $100,000 over 10 years, and so now you've written off $40,000. So really, your cost basis is now 60. It's no longer 100 because you've taken the deduction.
Right.
Now, let's say you sell it for 200.
Okay.
The taxable portion is going to be the difference between 60 and 200.
Okay, so 140.
So 140 is going to be taxable. 40 of that's going to be recaptured as ordinary income,
Okay.
taxed at ordinary rates.
Okay.
The 100,000 is going to be capital gains. It's longer than 1 year and 1 day, so it's going to be at a lower rate, but
Okay.
it's still capital gains. There's ways around that. So you can do like a 1031 exchange.
Oh, yes.
You say, okay, I don't want to pay tax on this now at all,
Yeah.
but I will exchange it for another piece of property that's worth $1 more, and I'll defer that gain until later. So what happens is your basis of 60,000 in the old property moves to the new property.
Right.
So you say, okay, I paid 200,000 for it. No, your basis is still 60.
Okay.
You follow me?
Yeah.
So now, if you sell it for 400,000, your basis is 60. So you got capital gains on
Yes.
the 340. Okay.
Okay.
But you're deferring that gain until later.
Yes. So it's not, you're not getting rid of the tax bill. You're just
just-
putting it off.
You're saying, I don't want to pay it right now.
Yeah.
I owe you, but I'm not going to pay it now. I'll pay
Right.
it later. Now, this can be a double-edged sword. Okay. So, for example, let's say you have a rental property. Let's say it's a fourplex, and you hold it for 40 years.
Right.
Okay.
Oh, you've got a lot of equity.
There's a lot of equity.
You're
okay?
making a lot of money
And
when
your
you sell
basis is now zero
that. Of course.
because you've written it all off.
Uh-huh.
Well, now you want to do a 1031 exchange because you don't want to pay the tax on $1 million.
Right.
Well, you can't just buy one property for $1 million and have that as a rental.
Right.
Now you say, okay, I'm going to do a 1031 exchange, but I'm going to pick 8 different individual single-family homes.
And you can do that?
And you can do that as long as the total is more than the sale price of the property you're giving up.
So this is an interesting question that you just hit on there, because I have people ask me this all the time.
Right.
And again, I know the answer, but I'm
Right.
not. You cannot take, so say we're talking about that $1 million
Right.
that you sold off this fourplex for $1 million. You need to reinvest it into several other properties to equal more than the amount.
More than $1 million.
You cannot say, well, I'll go ahead and pay taxes on $500,000 and invest $500,000 and defer that. You have to spend the entire amount.
If you don't spend the entire amount, okay, then the portion you didn't spend becomes taxable, and then the basis carries to the other properties that you did buy.
Okay, so you can not spend some of it and pay the taxes on what you didn't spend.
Correct.
You don't have to invest every dime of it.
Not every dime.
Okay,
But ideally you would if you don't want to pay tax.
if you don't want to pay taxes on it.
The downside to that, again, it's a double-edged sword, that, again, we'll use 60,000 as the basis, is going to be transferred to 8 properties all of a sudden. So each one has a $10,000 basis, even though you may have paid $400,000 for it.
Yes, so
So
there.
now when you sell the second property, it's an even bigger gain. So next thing you know, you've got all this money, and you're like, I have to pay tax on this money?
What a problem to have, though.
That's why real estate is so good.
Yes.
It just is.
Yeah, I mean, it does. It comes to a point where you're just like, okay, I have to pay it, right? I mean, that's one thing.
As much as it hurts.
As much as it hurts, it's great making money. It's great, deferring whatever you can defer if you can defer it. But there really does come a point, being honest, it just is what it is, where you got to pay. And,
Right, and the
be
tax-
happy when you do, because you made great money.
Right.
It's great income.
And let's say you did a 1031. You say, okay, I paid $450 for this one house.
Yeah.
A year later, you're like, it doesn't really make a very good rental, so I'm going to sell it.
Yeah.
You may not realize that your basis is $20,000,
Yeah.
but in your mind, I paid $450. I'm selling it for $425. I'm losing money. No, because you.
Yeah.
There's that gain that wasn't paid earlier.
Yeah. So you're not. Yeah. You don't have anything. But
Again, go in eyes wide open
Yeah.
and know what the consequences are.
yeah. And of course, if you talk to a CPA ahead of time, you'll know all that before you get into. Or EA. I always
EA.
call you a CPA. EA.
Everybody does that.
Yeah.
Because CPAs are really good at marketing.
Yeah, it
EAs,
must be.
not so
That's
much.
it's just common. Like everybody says CPA. I call you CPA all the time, and then I'm like, oh yeah, I have
And
that
most
wrong.
people don't know the difference. A CPA has a 4-year degree.
Okay.
They've taken 24 months of internship with the CPA office.
Okay.
They've taken a 2-day test to become a CPA. And
2
they're
days, that's all?
2 days, right, exactly. And it's they're licensed by the state, And about 20% of the test that they take is on taxes.
Oh wow.
Because a lot of CPAs focus on, business valuations or accounting or receivables, or there's a lot of different things that come with that. So like not all CPAs do taxes, because maybe they just don't like it. I mean, they like doing the accounting.
Yeah.
Whereas an enrolled agent has taken a 3-part test, and the test is on nothing but taxes.
Oh, okay.
And it's given by the United States Treasury, so they're licensed by the Treasury.
All right.
So by default, they can practice in all 50 states, whereas the CPA is limited to the state that they're licensed in.
Okay.
Yeah. So it's just, each tax professional has a different fit depending on what you need. You're running a business, you need accounting and all that. You definitely need a CPA.
Yeah.
Because the EAs don't typically do that.
Yes. Yeah.
Their focus is on taxes.
And again, the knowledge. I mean, I don't know if all EAs are as knowledgeable as you are, but
Thanks.
but you are very knowledgeable, which I appreciate. I appreciate very much. So, in closing, how do people reach you? How are people going to contact you if people have more questions? They need to talk taxes. What do they do?
Then go to our website. It's trinitytaxlv.com. Our phone number is 702-761-6550. If I'm not there, just leave a message. I'll call you.
Yeah.
That's probably the best way to do it.
Yeah.
Or email taxhelp@trinitytaxlv.com.
Okay. All right. And thank you. And I'll be seeing you soon.
Did you learn anything?
I learned a lot. I learned a lot.
Thank you.
And yeah, I'll be seeing you soon for this tax season coming up again. So thank you so much for joining us. Thank you for being here today.
Thank you for having me.
And I appreciate all your input.
Thank you.
All right. Thanks a lot. See you guys next week on Realty Check with Trish Williams. Remember, download our show on iTunes. Take a moment to share this with your friends, like us, comment, leave a review. We appreciate feedback. Thank you very much. See you guys next week.